What is Rrsp? Registered Retirement Savings Plan. Detailed Explanation 2022. In this post I will answer the question, what is Rrsp, Registered Savings Plan? I will explain how you can open Rrsp, who can open Rrsp, and when you can open a Rrsp. I will also explain the types of Rrsp, and at the end you will be able to choose the type that suits you as you plan for your retirement. Now, what is Rrsp, Registered Retirement Savings Plan? A Registered Retirement Savings Plan, Rrsp, is a registered savings plan with the Canada Revenue Agency, CRA, that allows you to save for retirement. Tax-free growth, tax-deductible donations, and other benefits allow you to save more for retirement than you would with a non-registered investment account. Rrsp can hold a wide range of investments, including as mutual funds, equities, and bonds. The Canada Revenue Agency, CRA, defines a registered retirement savings plan, Rrsp, as a savings plan that is registered with the federal government. Contributions to an Rrsp are tax-deductible until withdrawals are made. An Rrsp allows you to save for retirement by contributing a portion of your earnings before taxes are deducted. When you open an Rrsp, the CRA will record it and assign you a tax-sheltered number for filing purposes. Once you've established an Rrsp, you can make recurring contributions as well as one-time lump sum deposits at any time during the year or even just once every year or once in your life. The amount of money that counts as a valid contribution is determined by whether or not you make consistent contributions, or you are making one-time payments, or both. The amount of income tax you pay each year may be decreased by contributions to an Rrsp, which are tax-deductible. Knowing your contribution room is crucial if you want to maximize your contributions each year and maximize the returns on these types of accounts. You only pay income tax on the money when you withdraw from your account in retirement, making it tax efficient and simpler to open and operate than an individual savings account. The amount of income tax you pay each year may be decreased by contributions to an Rrsp, which are tax-deductible. Knowing your contribution room is crucial if you want to maximize your contributions each year and maximize the returns on these types of accounts. I'll look at the account types. You have three types of accounts to choose from when investing in a Rrsp. They are: Registered Retirement Savings Plan, Tax-Free Savings Account, Registered Retirement Income Fund. So, who can open an Rrsp? If you meet the following criteria, you can open an Rrsp. Have a social insurance number issued by Service Canada and keep it up to date with any changes of address or marital status during the year when contributions are placed into this account type. Otherwise, such payments would be deemed invalid. Anyone with earned income, including employment income, company or property revenue, and some types of alimony or maintenance payments, are 18 years old or older at the start of the tax year in which you want to contribute to your Rrsp and a resident of Canada for the whole tax year, January 1st, December 31st. Have earned income for the tax year in which you want to contribute to your Rrsp. Even if you have no taxable income and are not required to pay taxes on your Rrsp investments. For example, because they are registered in your spouse's name, you must file an income tax return for that year. Anyone with earned income, including employment income, company or property revenue, and some types of alimony or maintenance payments, can open an Rrsp provided you are under the age of 18. You can start an RDSP if you have earned income and a trustee is a family member over the age of 18. Now, a question. How much can you contribute to Rrsp? So, what's the maximum you can contribute to Rrsp in 2022? The maximum Rrsp contribution limit for the 2022 tax year would be $29,210. For the 2021 taxation year, the Rrsp contribution ceiling is 18% of the earned income reported on your tax return the preceding year, up to a maximum of $27,830. The maximum Rrsp contribution limit for the 2022 tax year would be $29,210. You can contribute 18% of your earned income to an Rrsp, up to the maximum contribution limit for 2022. In 2022, the maximum amount you can contribute to your Rrsp is $29,210. Any unused portion of this money may be carried forward and applied in subsequent years. It must be used within 20 years. If you cannot deduct all or part of your contributions because you earn too much, the amount that exceeds your deduction limit will not count toward your annual Rrsp contribution capacity in subsequent years. The Rrsp deduction limit is reduced by any employer contributions made under a pension plan or supplemental pension plan such as a group registered retirement savings plan, GRRSP. Another question. When should you withdraw from your Rrsp? You can withdraw funds from your Rrsp at any time, but you will be taxed on the amount you withdraw. If you want to utilize the money for things like buying a home, paying for education or training, or supporting yourself while unemployed, you may choose to withdraw some of your Rrsp contributions. There are some limitations, but you can withdraw money from your Rrsp at any time. There are no fees associated with withdrawals, but the amount of tax that would be owed on the amount withdrawn will be deducted from your account if you withdraw before age 65 and your withdrawal is not a qualifying event. Note that you can take money out of your Rrsp at any time, provided no penalties apply, but if you do so for retirement-related reasons, the amount will be considered income for tax purposes in that year. Depending on how much money was initially contributed by you or your company, you can possibly be required to pay additional taxes. For instance, if Gordon contributes $5,000 each year to his Rrsp and withdraws $7,000 when he retires at age 65 with a marginal tax rate of 29%, he would owe $1,620, $7,000 x 29% of his withdrawal in taxes. Another question. When is a withdrawal considered to be a qualifying event? A qualifying event is one of the following: passing away, becoming disabled, being unable to work due to illness or injury, and being able to prove it. Receiving payments under the Quebec Pension Plan Disability Insurance or Canada Pension Plan Disability Benefits. Turning 65 and becoming eligible for old age security through an application made by another person on their behalf and becoming qualified for employment insurance benefits because their employer fired them without cause. So, what is Rrsp contributions? TFSA contributions can be made using pre-tax cash, however Rrsp contributions must be made with after-tax funds. Contributions can be made at any time throughout the year. Your income will be taxed at your marginal tax rate plus an additional 20% penalty if you take money out of your Rrsp before age 71 and don't meet the requirements for a qualifying withdrawal. There are no credits or deductions allowed for this distribution, which is known as a penalty. If you continue to make regular monthly payments until you are 71 years old, there are exceptions to this regulation. There are two types of contributions: regular contributions and lump sum contributions. Regular contributions must be made by either payroll deduction or cash or check payment by December 31st each year. Otherwise you will miss out on getting any deduction at all. Lump sum contributions have no deadline but have different rules around them. Another question. What is Rrsp tax implications? Since the money you contribute to an Rrsp is not taxed until you withdraw it, you benefit from your contributions by saving money on taxes. The money you invest in your Rrsp is taxed at a lower rate since your contribution to the account is subtracted from your income. Over time, you can save on taxes by doing this. However, the contribution amount is put back into your taxable income for that year when you withdraw from your Rrsp. This regulation has the following exceptions. For instance, if you need to withdraw money due to extreme financial hardship or a medical emergency involving you, another person who depends on you financially, or both. In some circumstances, The withdrawal might not be subject to taxes or penalties depending on whether there are any circumstances beyond normal. A registered retirement savings plan, RRSP, could aid in lowering both income tax and capital gains tax if it is a component of your overall financial strategy. For instance, your adjusted annual income would be $49,000 if you made a $1,000 contribution to a retirement plan and received $50,000 in income for the year. This results in a $1,000 reduction in your taxable income overall for the year and a $300 decrease in the amount of taxes due. The primary advantage of using an RRSP is that it lowers taxes now by reducing taxable income while delaying taxation until a later time when the money can be withdrawn without incurring further taxes. Another question. What is RRSP spousal plan? A spousal plan is when one person establishes an account in his or her spouse's name and names the beneficiary as the spouse. Because just one spouse can withdraw money from the plan at any given moment without the other's permission, the plan is not regarded as a joint account. Your spouse must be the only beneficiary of the RRSP, and they must both agree to any withdrawals you make from it after you turn 65. The age when most people start receiving government pension payments. An individual must have earned income in that year either through job or self-employment, in order for their donation to be eligible as a deduction on their personal tax return. If you don't have enough earned income during this time, you should think about making additional contributions within 60 days of filing your return. However, if you do so, your contributions won't be eligible for future tax deductions until you withdraw them from the RRSPs. I'll look at a tax-advantaged option to save for retirement. A tax-advantaged method of saving for retirement is through RRSPs. By contributing money to an RRSP, you can lower your taxable income by deducting the amount from your income. When you withdraw the money, you will be required to pay taxes on it, but because you will probably be in a lower tax rate by then, the cost may not be as high. Additionally, matching funds are frequently matched dollar for dollar if your RRSP contributions were made while you were employed full-time by an employer that offered matching contributions to its employees' retirement plans, which means that you might be receiving 100% of what you contribute back from your employer without paying any taxes at all. Therefore, making contributions to an RRSP not only helps to lower future income taxes, but it also gives you access to free money. Now, here are some essential RRSP details. Special tax breaks. The ability to receive special tax breaks when contributing, earning investment returns, withdrawing money after age 65, or retiring from employment at age 55 or older with minimum RRSP contributions made each year during an accumulation period makes an RRSP the best registered retirement plan for saving money. For tax reasons, contributions made to an RRSP are regarded as a component of your net income. Up until you withdraw them, your money grows in the plan. While making contributions to an RRSP lowers your overall taxable income, if you withdraw the money before age 71 or use it for non-retirement expenditures like a house, it will be fully taxable, though there are exceptions. In conclusion, what is an RRSP in summary? A tax-deferred retirement savings vehicle created to aid in the development of your retirement savings is the Registered Retirement Savings Plan, RRSP. An RRSP allows you to start investing early, and it's essential to have a retirement plan. The Canadian government offers tax advantages on funds saved in certain registered schemes. You can grow your savings more quickly in a registered account than you might in a typical non-registered investment account since it allows you to prepare for the future on a tax-sheltered basis. Your taxable income for the year will increase when you take money out of your RRSP. Remember that the funds you use to fund your RRSP originate from income that has already been subjected to tax. Because pre-tax contributions are taxed when your future income is lower, you can save money now while also lowering your future tax obligation, retirement. Doing what is good for you ultimately matters. Don't be afraid to get in touch with a financial expert if you need assistance choosing the finest RRSP plan in order to make the best choice possible. I believe this post has answered the question, what is Rrsp? If you have any questions or concerns about these plans and how they could benefit your retirement savings, kindly spell it out in the comments section.